The E.W. Scripps Company, located in Cincinnati, Ohio, is a diversified media enterprise and one of the largest independent owners of local television stations in the United States. The company's local media segment operates 61 TV stations across the country, reaching over 36% of U.S. TV households. The Scripps Networks division is comprised of 8 national news and entertainment networks that reach nearly every U.S. household over the air and are also widely distributed on both pay TV and connected TV. The company has about 88 million shares, trading around $220 for a $200 million equity market cap, $2.6 billion of net debt, $600 million of preferred equity, for about a $3.4 billion total enterprise value. We have Scripps' CFO, Jason Combs, and Chief Communications and Investor Relations Officer, Carolyn Micheli, here with us today. Thank you guys so much for joining us. Scripps has gone through a pretty significant transformation and reorganization over the last several years. Talk us through how Scripps' strategy has evolved and what the company's most focused on today.
Yeah, so we're a media company that's been around for 146 years, and so we've been through a lot of transformation. We've been in and out of businesses, radio, newspaper, cable networks, cable systems, podcasting, and what you've seen over the last 5 to 10 years is you've seen us really double down on TV. And Hannah's introduction kind of touched on that. I started 10 years ago. When I started, we had 27 local TV stations. We now have more than 60, so significant growth there. And then on the national networks, really I would say through both acquisitions as well as some organic investment, we've created this stable of 8 national networks that reach audiences from coast to coast. So when you look at our current footprint, what our focus is how can we take this really strong group of both local and national assets, and how can we drive connection? And that connection, by connection, I mean connection between the audiences and our brands to provide them live news, entertainment, and sports programming, but also between the advertisers and the audiences, because ultimately that's where the financial benefit comes in for our shareholders.
Great, thanks. That's really helpful. And then I want to jump into the regulatory outlook, but just starting to kind of set the stage, can you talk about Scripps' capital allocation priorities from where we sit today and where you want to be from a leverage perspective? And then from there, we'll move on to the regulatory side of things.
Yeah, absolutely. So I say this every earnings call. For those who listen to our earnings call, our number one capital allocation priority is debt pay down and reducing leverage. And I think we've made a lot of progress there. Q2 of last year, our leverage peaked at 6 times. The most recent quarter, we were at 4.9 times. So I think a lot of progress there. Tremendous amount of cash flow was generated last year as a result of political, and we were able to really direct that all towards debt pay down. If you look at since the ION acquisition, which was back in 2021, we have applied 99% of our discretionary cash flow towards debt pay down. And when you look at across sort of our other local broadcast peers, you'll see that is sort of an industry-leading number. So definitely progress being made on that front. We also recently completed the refinancing and extension of our 2026 and 2028 term loans, as well as a revolving credit facility, and we did so at what I would view as some really good economics. Obviously a really elevated rate environment right now, and it was a very significant portion of our debt that we extended, but we did so while limiting the increase in our average cost of debt to less than 1 percentage point. So certainly we're pleased with that, and we continue to make expense, I would say some tough expense management decisions to continue driving the maximum cash flow we can to apply again towards debt pay down. Our long-term goal is the low to mid 3s in terms of leverage. It's tough to say when exactly we'll get there right now, just given the amount of turmoil going on right now. Obviously, with things like the tariffs and everything else, there's a lot of uncertainty in the ad marketplace. But what I can tell you is I feel really confident that as we look at the 4.9 we ended Q1 in, that you will see us make continued progress between now and year end towards that ultimate goal.
Thanks, that's helpful. And so you're our first session of the day, but I anticipate, like I mentioned during the opening remarks, that we'll be talking a lot about the regulatory environment, and there's a lot of optimism right now on the broadcast side for deregulation, which could potentially spur consolidation and really be impactful for the local broadcast group. What's your perspective on Chairman Carr's policy direction so far? When do you think that we'll start to see real progress on relaxing the ownership cap and modernizing other broadcast rules?
Well, I mean, I think we're very pleased with all the comments that Chairman Carr has made. Clearly, he has a view that the rules are antiquated. And also, I think some of his comments have highlighted to me the importance he places on local news, which is a sort of foundational thing for what we provide to the communities that we serve. And so, in terms of the rules being antiquated, I mean, you look just at, for example, the national cap, which was put in place in a time when we were competing against a couple of other local broadcasters. The reality is today, for those same ad dollars, we're competing against big tech, and the rules have not followed the way the ecosystem has changed, and that's put us at a disadvantage. And so we're very supportive of any opportunities to change the regulations. I think it can be extremely beneficial for our industry. And I'm optimistic that I know there's a little bit of noise now with the Symington announcement yesterday. We continue to believe that as the year progresses, they will fill those seats fairly quickly. And once you have a quorum, once you have a Republican majority, that you will start seeing change get pushed through.
And then I believe there was a Democratic commissioner who also announced he'd be leaving shortly as well. So I believe that would leave us at kind of a 1-1 situation. What do you think that means for some of these rules getting changed, and what would the timeline look like?
So I'll give my comments, and if you have anything else you'd add, Carolyn. Yeah. So I think that I believe that you'll see the next Republican seat filled fairly quickly, and that will give them a quorum, and that will give them a Republican majority, and I think they'll move quickly on the other seats as well. But I don't know if you have anything else you'd add.
Well, just how aggressive Carr has been in his commentary. I mean, he even climbed a broadcast transmission tower to make a point about his support for local broadcasters. None of us have done that. So I think it's been very aggressive commentary, and we expect things to happen quickly. And he'll replace Symington and get Olivia Trusty in there quickly.
Okay, great. So in terms of consolidation and scale is very important in this business. What do you think some of these changes might mean for the broadcast industry? And I guess in terms of M&A, what would be the most compelling M&A opportunities for Scripps? How do you kind of envision your role in further industry consolidation? And then we'll go forward from there.
Yeah, I mean, I think this is an enormous opportunity for Scripps and for the entire industry. Ultimately to reshape our portfolios in a way that makes us all more economically durable, so that we can continue to serve the communities we support. In terms of Scripps specifically, given our balance sheet, I don't see us being a major buyer in this marketplace. I see us more focused on swap opportunities, as well as some select asset sales as well, all towards that ultimate goal of improving our short-term operating performance. And so I'm looking forward to when those changes are enacted, not just for what's going to mean for Scripps, but the entire industry. And ultimately, I think that our shareholders will benefit as we reshape our portfolio.
What kind of benefits do you see in terms of swaps and those sort of deals for improving kind of Scripps's operating performance? I mean, how big are the synergies, and what does that mean?
Yeah, the synergies are significant. We haven't quantified anything publicly, but certainly, when you look at the back office support and all of those sorts of things that are required to run a TV station and to potentially have a duopoly in a market, a Big Four duopoly, there's a lot of overlap and a lot of cost savings that would come as a result. Also, just from a sales perspective and a market share perspective, it gives you as you're going into to discuss opportunities with various advertisers in the marketplace. It just gives you positions you in a much different place if you're bringing to the table two Big Four stations in a market.
That makes sense. And then there's been some other potential areas for regulatory relief that have been floated. For example, a cap in reverse comp payments, and then a few additional things as well. What are kind of the other regulatory items on the table that you could see changing aside from just the ownership cap?
So I would say, first of all, we are in favor of any and all deregulation. Certainly the ownership cap is I think, an important one. We're also would like to see some changes in the in-market Big Four ownership rules, as well as virtual MVPDs, and in terms of our ATSC 3.0 aspirations, a sunsetting of the 1.0 standard. You mentioned virtuals specifically, and we get asked that question a lot around virtual MVPDs and potential changes there that would allow us to negotiate directly. I'll say, first of all, my personal opinion is that the cap and the Big Four ownership rules probably happened before that. But we would be very supportive of that change. Ultimately, if you look at the setup today, the networks are not incented to negotiate in the best interest of their affiliate partners, and so we believe that if that rule were to change and we were able to have direct negotiations, ultimately it would drive a better outcome for the local broadcasters.
For those less familiar with kind of the setup for virtual MVPDs currently versus traditional pay TV, can you just kind of walk through what that dynamic looks like today and what it would mean, I guess, for you guys if that change occurs?
Yeah, so on the traditional side, we have direct negotiations with our MVPD partners, and then we pay a fee then back to the network. So we recognize the gross revenue, we pay an expense, and then that gets us to our net. In the case of virtuals, the networks negotiate on our behalf and then bring, sort of essentially to all the broadcasters, here's what we've negotiated. And the reality is they're not just negotiating our deal, they're negotiating a deal that encompasses a bunch of owned and operated networks they have in a whole variety of things, and then they're allocating value across that. And that goes to my comment on they're not incented. They're not incented to allocate the value out of their own pocket. And so as a result, the net outcome is not as beneficial as if we were able to negotiate that directly.
So what could that mean for your economics if that change is made?
It's nothing we've quantified publicly, but I would say I think it could be a significant uptick to both the top line and the bottom line, and all. So I'll leave it at that. I probably can't say any more than that.
And then the last piece here, I believe Symington had put out an op-ed at one point discussing a potential cap on reverse comp payments as well. He'll be leaving, so not sure how much of that stands, but any thoughts around that and how likely a scenario that might actually be?
I think it was a little unclear. I've never seen Carr come out and talk about that, so it's a little unclear to me what his position is on it. But again, he's certainly been aggressive about support for local broadcast and feeling like the networks are monopolizing our business. So I think we're optimistic that could go forward. I think what Jason said about ownership cap as a priority is right.
That makes sense. And then you discussed some other potential non-core asset sales publicly in the past. I think we touched on them last year when you guys were here. Can you just quickly highlight the progress that has been made there and any other elements that could help accelerate financial flexibility for you guys?
We had given a range previously of a real estate target selling $50 to $100 million in real estate. As of now, we've closed on $63 million, and that is 5 broadcast towers and 1 TV station building. We're kind of in that range now. I would say nothing else is active, but we continue to look across our portfolio, and if we have a particular piece of property that is driving a lot of interest, we would absolutely be open to entertaining that, and again directing those funds towards debt pay down. And so I think from a non-asset or a real estate perspective, that's kind of where we're at. I spoke earlier, and it's kind of tied to the M&A discussion, that we do look across our portfolio, both our local portfolio and our national portfolio, and identify which of those assets we view as less core and ones that for the right price we might be willing to monetize. We continue to do that with the heavy lens towards what's happening in Washington with deregulation. And then you mentioned financial flexibility. I think the other thing is we're very focused on all those things, but we're also trying to maximize the underlying operations of the business. And so I briefly touched on it earlier, but maybe I'll go a little deeper on the levers we're pulling within our Scripps network segment. So we gave out a margin expansion target of 400, 600 basis points for that segment for the year, which is a pretty aggressive target. We made some really tough decisions as we exited last year, and ultimately we're seeing the benefit of that already. In Q1, our expenses were down 16% year over year. Our margin was up 870 basis points year over year, so kind of well above the top end of our full year guide. and we believe we'll continue to see the benefit of those decisions. So for us, it's about both capitalizing on the M&A environment, but also being laser focused on improving our ongoing operations.
And last point on that, I believe at one point the company had put your Bounce network up for sale, and that's kind of been put on the back burner at this point. Can you just talk about kind of thoughts around selling that moving forward or holding on to it, and any of the other national networks as well?
Yeah, so I mean, I think that, and it goes back to my comment. For the right economics, we would entertain, selling any of our, not any of our networks, but some of our networks over on the national network side. But the reality is, you kind of alluded to it. The focus has shifted right now, and everybody's focused on local M&A, and anything else is absolutely on the back burner at this point. And we just want to sort of, there's a lot of work you need to do to set yourself up so that when that deregulatory environment happens, you're ready to go. You can't wait until then and then start running. You need to be doing a lot of prep work, and that's what we're focused on right now.
There was some commentary from, I'm not sure if it was you or your peers on the most recent set of earnings calls, that swaps and other deals like that could probably start happening before we see actual changes to the regulations. Do you anticipate that could be a factor?
Yeah, I mean, I think you absolutely could see deals go through or get submitted to the FCC through a waiver process, and so I think that's a reality, and I think maybe that reality is even heightened given the potential for a little bit of a delay given the announcements with Symington.
Mm-hmm. That's helpful. Hoping to discuss the company's expansion into sports programming with Scripps Sports and your approach to live sports moving forward, both on the local and the national side. And then if you could just touch on your view of the collapse of the RSN model and how things will play out in that ecosystem from here.
Yeah, so maybe first I'll start by recapping for those who haven't followed our story as much, sort of the two discrete strategies we have. We have our national strategy, which is using the national reach of ION and leveraging that to provide coast-to-coast reach across a bunch of different platforms for leagues that may have been underserved from a reach perspective before. And we have kind of two foundational sports properties there. We have the WNBA, 15 weeks over the summer, every Friday night you can catch WNBA on ION. And then we have the NWSL, which is north of 20 weeks on ION as well. That's on Saturday nights. Recently, we've added a couple of other sports properties, more event-driven around that. We actually announced about a month ago a partnership for the first ever Sports Illustrated Women's Games. That's going to take place in the fall, and so we're really excited about that. It's a week long, or 6 days long on ION. And then we also announced a partnership to be the TV partner for the Fort Myers basketball tip-off women's college basketball tournament. On the local side, our strategy was leveraging markets where we have an independent station to provide reach to those who were struggling with the RSN model that you alluded to. 3 years ago, when we started this, we said, look, the RSN model, we think it's really broken. And I think we were correct. And so what we've seen is teams were struggling with two things. The economic model was breaking, and there was very limited reach that the RSNs were bringing, because even in a market if that had 50% pay TV coverage, for example, half of that might not have carried the RSNs. And so what we bring is a much broader reach and a stabilization in the economics, and we've had success there. We've won 4 NHL teams, and we also have won local rights for a WNBA team, and they're seeing that growth in audience. The Panthers, who unfortunately lost last night in a tough one in overtime, the Florida Panthers, this was their first year on our airwaves. Their ratings were up 149% versus what they had on the RSN the year before.
Wow, that's significant. And then MLB rights, there's been a lot of discussion in the press about what might happen here. How do you anticipate things will shake out there?
And you're talking sort of the national rights versus
Yeah.
our view on local rights. So from a national rights perspective, I mean, my guess would be they end up with something. They follow the blueprint that several other leagues have followed, which is to have have your rights deal rooted in linear with streaming as a complement to that. That's what the NFL has done, for years with their rights deal and their Netflix games and their Amazon games. It's what the NBA deal that was just announced last year is, with a heavy linear footprint, but also Peacock and other streaming. And it really gives you the best of both worlds. It gives you the largest reach vehicle, which is linear TV, and the added economic benefit that streamers bring. So that's my guess, but we'll just wait and see.
Yeah, we'll have to see. And then could you remind us of Scripps' exposure to local versus national core advertising, and then talk a little bit about what you're seeing in advertising in general, locally and nationally, touching on any core ads categories that are impactful at this point?
Sure, I'll take that one, Hannah. So we have our local division in which 70% is from local businesses of our core advertising, and about 30% comes from national businesses that want to buy specific geographies. And then in our national network side, which is a little bit of a differentiator from some of the broadcast peers, it's all general market scatter, upfront advertising, direct response. We tend to skew heavily toward direct response because of our multicast networks. In terms of what we've been seeing, it's been a tough environment. I was at an ad panel yesterday, all the big agencies over here on 42nd, and they were somber about the going into the upfront, what that looks like. Certainly the tariff commentary and uncertainty. They talked a lot about consumer confidence and lack of consumer confidence. Today we had a headline out of Cincinnati, actually, where we live, that Procter & Gamble is planning to lay off 7,000 people over the next 2 years because of uncertainty about pricing, tariffs, and consumer behavior. So all of those are sort of the bad headlines right now. On the core local side, we're faring a little better. The local businesses that are less impacted, in some cases by tariffs, have been holding steady. We were down about 3% in the first quarter. Looking at the same range for the second quarter, we had guided to down low single digits. Auto continues to be weak, and certainly that's one that both on the national and the local dealer level you're going to see impact of the economic commentary out of Washington, et cetera. Retail hasn't been great. On the other hand, services, which is a big consumer discretionary category, has been okay. It's held pretty steady. And home improvement. Thank heavens people continue to want to fix up their homes, even post-COVID. A lot of people working from home, so that's been a good story. The other things that are helping us, and still talking on the local station side right now, is the sports, and Jason talked about the success we've had with that. The Tampa Bay Lightning is our newest NHL team. That season will start again in October, so we'll start to see an uplift from that. We also have the Aces, the WNBA team in Las Vegas that's starting that last month in May. So we hope to get a little uplift from that. Haven't guided that in really. Just have seen with other local teams that we've done a nice boost in core in those regions. And then the Pacers, which I have no idea where that stands right now.
Starts tonight.
Okay.
We all are rooting for a Game 7.
Yes, please. Yes, that'll help us.
We own the ABC in Indianapolis, so. Yes.
But we've seen nice money laying in because of that, and even though there's been expectations that the viewership won't be as good, we'll still benefit from that. So.
It'll be very strong in Indiana, though. I can tell you that.
Yes. We have an ABC in Indianapolis that we'll see benefit from that. So, and then on the national side, again, sports is a great story for us. The WNBA, we're in our third season with them, working on the renewal, which is going very well. For another few years ahead with them, and also the NWSL. So seeing really nice growth in both the rates we get for that inventory on ION. As you may remember, there's the Friday night franchise with the WNBA and the Saturday night franchise with the NWSL. And so really pleased with those. And did you mention, I'm sorry, the two new franchises we're doing?
I did.
Yeah, okay. So those in the fall, when we don't have those 2 seasons, we'll have a nice benefit from the new agreements we've made. So, I think that kind of covers them.
Yeah, that's helpful. Can you just let us know when we should expect to see kind of the renewal announcement with the WNBA or timelines around that?
Soon, this summer,
Okay.
before the end of the season, which ends late August, early September.
Yeah. And then touched a little bit on the national side of the local business. Anything else to comment on related to the national network side advertising that you're seeing in the DR marketplace?
DR has been a mixed bag. Again, that's a consumer. It's a act now to spend category, and advertisers love that immediate ROI that they see from it. I have to cheat and look at unless you remember the specific. I have it right here though. Let's see. In the first quarter, we were down in the high single digits, but we were seeing average unit rates up about 5%. In April, they were up in 10% range, so that's positive. We don't guide to that that specifically, but generally speaking, it's been holding steady, and we continue to. I think we guided to down low singles in national networks for Q2?
We guided to flattish.
About flat,
Yeah,
that's
about
right.
flat, and that's some of the benefit that Carolyn talked about specifically for sports with the WNBA season and NWSL season kicking into high gear.
Great.
We feel fortunate, as Jason said, that we were able to see the sports things coming, especially with women, and have formed a really great relationship with the WNBA, and they really like that the over-the-air reach that we give them. That's a unique, value proposition, and really has incrementally added to their audience. And so, even though there's a lot of expensive sports rights out there and a lot of competition, we've carved out a niche that we believe we can maintain.
And given the advertising marketplace right now, that guide of about flat was, I would say, a pretty extreme outlier to a lot of our peers.
Yeah, that's really helpful. We'll be hosting a sports panel later today during lunch, and there's going to be some specific questions on women's sports, since we know that's a really exciting area right now as well. And then just continuing the ads conversation, but focusing more on political. It's a focus area for many investors, and the 2026 midterms will be coming up before we know it. Any commentary around political expectations for 2026 and then the next presidential cycle in 2028? How are you guys positioned to benefit?
So in the 2020, we of course did record advertising until the 2024 presidential election. We were up 30% over the last presidential election. We expect to continue to be the place that campaigns want to spend money, because they're the regional reach. It's very efficient dollars for them, and it's also an engaged audience who watch our local news programs. So that sort of 50% range, getting about half of the total spend, which continues to grow. So our share is stable, and the pie continues to get bigger. That's a good story for local broadcasters. I don't have any. So for the midterms, obviously expect the Democrats to try to get their act together and really make a run for it in the Senate and the House. That will obviously mean good things for our spending in our markets. No predictions right now on specific markets yet.
Okay. I want to see if we have any audience questions.
Mario has a question.
Here you go.
Give the man a mic.
Thank you. That's a terrific update. You talked about perhaps selling, $53 million of the blah blah real estate. You have a shareholder that owns your preferred out of Omaha, and there's a lot of financial engineering that you can do. Assuming we're now in October, you've done an extended contract under WNBA. You're looking into the election for 2026. You got to get greater clarity on local. And would you take part of the sports business or ION public and look at accelerating your financial engineering? You can't dismiss that, Jason. You love doing these deals. You're thinking about everything.
So I can't really discuss any specifics.
No, I agree with that, but I just
what I would
did.
say is,
Thank
Mario, I would agree. We look at every opportunity we can to accelerate things, and are open to a lot of different ideas.
Okay. Any other audience questions before I wrap up with a few more? Go ahead. Do you have something else to
Yes,
add?
I was just going to make sure we had a chance to mention our connected TV strategy, because I think people think of us as a linear television company, and we've been really aggressive getting into streaming revenue. So that was a 42% increase in our revenue. It's over $100 million now. It was nothing a few years ago. So that continues to be a good growth area for us. We have a great leader of that business, very aggressive, and he's really helped us to claim our space in that industry, despite the bigwigs that tend to dominate it.
That's helpful. I guess what do you see as the primary areas of focus for SSP within the CTV space right now?
The primary,
focus areas within CTV, yeah.
In terms of industry,
Yeah.
spend categories, I don't know. It's sort of all over the map. Our sales teams sell the CTV with other things. So we're selling it for sports. We're selling it for to pharma companies. It's really across the board packages. Where they want a little of everything cross-platform.
That makes sense.
I would say the only other thing I'd add there is we've done a good job of growing through expanding the platforms we're distributed on, and right now the heavy focus is on how we can improve the monetization on each of those platforms, and that's driving a lot of our growth.
That's helpful. And then just one more to kind of close the loop on all the regulatory side of things. You mentioned ATSC 3.0 or Next Gen TV, kind of accelerating that transition could benefit you guys. You announced a JV with a few of your peers back in January, EdgeBeam. So how do you see ATSC 3.0 transforming local broadcasting, and how are you thinking about monetization as well as the opportunities for you guys and the industry in particular?
Yeah, so we were really excited to be part of the EdgeBeam announcement. The 4 broadcasters who are part of that, we represent 98% coverage of the U.S. with our broadcast spectrum and a lot of depth in certain markets where we overlap. And so I think there's a significant opportunity there. I think we're very close to hiring and announcing the CEO of EdgeBeam, and looking forward to them bringing a team on and really getting things moving. In terms of the industry, I think it's a huge opportunity for the industry. I don't think it's significant dollars here, this year or next. I think it's more in the back part of the decade. But if you look at the demand for data and how it grows every year, I know some people say, well, how do you guys think you're going to be able to compete against 5G? We look at it as we're going to be able to provide a complement to 5G to help provide the supply for all the demand that there is right now. And I think we'll be really focused on a couple of areas to start. I think broadcast GPS has a lot of traction right now with a lot of proof of concepts we're doing. I think there's a lot of applications in the automotive industry and the digital signage industry. But ultimately, I think that I've sat in the seat for 4 years now. I can tell you we're not putting out numbers because we need the EdgeBeam team to get built out. But I'm more excited about 3.0 and data casting than I've been in the 4 years I've been here. Certainly, back to the regulatory piece, an important piece of ultimately having the success we want to have there is we need to have the 1.0 standard sunset, and there's an ask out there by the NAB to do that.
Mm-hmm. Do you have any sort of timelines around when you would expect that to really pick up?
So I would hope that as we get the Republican FCC, that's something that could move here later this year. The target date is the top 55 markets in 2028 and all the rest in 2030, I believe. Great.
Any other audience questions? Don't think so. Is there anything else go ahead, that you guys want to highlight before we hop off?
No, this was great.
Okay.
Thank you so much.
Thank you both so much for flying in. We really appreciate it. It was great to have you.
Thanks.
All right, thank you.
Chris Morangi is a co-CIO, and Sergey Glazewski, Hannah Howard, and Justin McAuliffe are portfolio managers Gabelli Funds. This podcast is an excerpt from Gabelli Fund's 17th Annual Media and Entertainment Symposium. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of March 31st, 2025, affiliates of GAMCO Investors Incorporated beneficially own on behalf of their investment advisory clients or otherwise approximately 31.43% of Atlanta Braves Class A, 6.32% of Class C, 11.32% of Sinclair, 5.41% of EW Scripps, 2.67% of Gray Media Class A and less than 1% of Common, 2.41% of Tegna, 2.25% of Ryman Hospitality, and less than 1% of all other companies mentioned. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI 800-422-355-4914, 921-5100 fax, 914-921-5118 info@gabelli.com.